Welcome to the all-in-one presentation. I want to go through some high-level points and then some granular detail as to how this program is designed to work and how I think once you're done watching it, how it will probably be a paradigm shift in what you can do with a mortgage tool like this. For so long, we've been accustomed to doing things the traditional way when it comes to closed-ended mortgages, and this product has given me faith again that the mortgage industry can actually serve a greater need, which is to help our clients and homeowners retire with a lot more in their pockets so they can enjoy those years. And I think this product really does go a long way in facilitating that outcome. So thanks again for watching. And as always, if you have questions, we'll have a link where you can schedule a no pressure phone call with myself or my team, and we'll walk you through specific scenarios that you may have questions about. So enjoy the presentation, and thanks again.
This presentation is geared towards loan officers, homeowners, home buyers, real estate professionals, and of course fiduciaries. It really encompasses the market. And I truly believe that although it may not be a proper fit for everybody, everybody should certainly know that this product exists. We are often asked, why would we create a new type of way to borrow and lend for real estate? It's a common question. Of course, people are sort of apprehensive about new things out of the mortgage industry. I understand that. But let's just break down a few things that we know. First and foremost, we know that most people need to borrow money in order to buy and own real estate without question. We also know that interest rates continue to be the predominant influencer of decision making. To offset costs, especially when interest rates are higher, borrowers tend to look for lengthier loan products. I would argue that even when interest rates are lower, they look to obtain and put in place lengthier loan products. This is because everybody's focus is actually based on the payment, whether or not it's going to be affordable or not. When people think about refinancing or they think about financing real estate in general, ultimately the focus is to make their monthly obligation as affordable as they possibly can. Interest rates are the primary driver of their decisions, and they also extend the time out in order to reduce their monthly obligation. But as you know, the longer you remain in debt, the more expensive that borrowed money becomes. Today, 9 out of 10 Americans uses this gold standard 30-year loan term to finance their homes with. What does that lead us down? What kind of results have we seen occur over time? Well, it certainly impacts the financial health and mobility of a nation, the way we finance real estate. As a data point to use to make this argument and to highlight the lack of affordability and how that gap, that disparity is continuing to widen, just look at the increase in home prices across the United States since 1965. It's estimated that they have increased by 118%, while income has only risen by about 15% over the same time period. So not just housing affordability, by the way, but the affordability factor for all things has just continued to widen. Mortgage debt now exceeds $12.5 trillion in the United States. This is just the principal outstanding on homes, residential real estate. This does not include the interest that people have committed themselves to. If you were to add that number to this number on screen, that number would probably be well over $20 trillion in total mortgage obligation. The national retirement income deficit continues to also grow. This is the money needed for pre-retirement households to have on hand, saved for future needs, to live at their current standard of living during the retirement years versus what they're on track to have saved. It's estimated to be somewhere in the neighborhood of about $3 to $4 trillion wide. This means that people are not saving enough for future needs. And you don't have to look too far to understand that the mortgage plays a big role. Thank God we have access to credit like we do in the United States. It's a very vital component to housing. There would be no home sales like there are today or like there have been over time without the mortgage and without our industry. But the mortgage debt itself impacts wallet share. Of all the money spent servicing household debt, nearly half of it accounts for the mortgage. Now, traditional loans certainly have their place. There's a period in life where traditional loans are the most suitable product. They create payment dependability. People are familiar with them. There's not much education that is necessary to understand how a mortgage works. And a lot of times it offers first-time home buyers lower down payment requirements. So these loans, traditional mortgages like the 30-year fixed, are really designed to benefit those, that tend to have a less established financial budget. But they also can set a lot of people back. They prove to be slow. They prove to be inefficient in the way that they use money. They are rigid financial products. And all of this leads to an expense level that is hard to get rid of. Most people will spend their entire adult life paying for their home because of the mortgage. Let me give you some quick math. If we were to buy a home for $800,000, finance $640,000 of that using a 30-year fixed at 6%, the total payment obligation on that would be $1.38 million. That is 73% more in total than the home's value at the point of purchase. The reason why this happens is because of the mortgage. It comes with a lot of interest expense. 6% today, as I sit here and make this video, is relatively speaking, a great interest rate. Historically speaking, it's a great interest rate. But $741,000 in interest cost is not a low amount of money. In fact, it's 116% of the amount being borrowed in principal. So you're paying more in interest than you'd have to borrow in principal to make this purchase possible. It's not that great of a deal. That's why everybody's focus is interest rates. Well, what if interest rates were lower? In this example, I'm using a 3%. It's still a lot of money, nearly $1 million in total payment obligation. It would increase, a 30-year fixed at 3% would still increase the total cost obligation by 22%, or it's 22% more than the home value at point of purchase. Over $330,000 in total interest, and that total interest obligation is still 52% of the principal being borrowed. In other words, for every $100 being borrowed for this mortgage, the customer would be charged $52 in interest. And we know that mortgages are front-loaded with interest cost. This is the way they are. They've been this way really since the Great Depression era. Money flows in only one direction, and that's towards interest payment obligation first. In fact, about 50% of the total interest charged on a 30-year fixed loan will be consumed and collected by the lender in the first 10 years alone. And we know also that people tend to refinance or pay off and maybe go get another 30-year term mortgage within about 7 years. So people are really stuck in that early portion of an amortization repayment schedule, paying a lot of money in interest. The bottom line here is that low rate loans still charge high amounts of interest. They're costly. When you really take a step back and analyze what a loan is, you can really summarize it as a mathematical equation. All financial products are just a simple mathematical equation. And they really only have three variables at play. Interest rate always matters, but so does the principal balance in which interest is being computed on. And so does the amount of time that somebody's going to be in debt, right? The same aspects or features or variables apply when you invest money. Think about investing money and trying to grow the worth or the value of an investment asset. The same principles at play: the rate of return, what the balance is, or the principal, and also how long you're going to do it for. What good would an investment tool be if the rate of return was fixed and high, so it felt good, but the broker only allowed you to put in maybe the requirement was maybe $2,000 a month in investment activity. That's the minimum obligation each month, but only about $100 of that for maybe a very long time went towards principal, and the rest of it went towards their fees. That wouldn't feel so good. Instead, the right way to invest and the way that tends to work is by relying less on rate of return. Rates are rates. Let the market go up and down. We know it does that. But instead, start earlier in life and invest with as much money as you possibly can. Why does this rationale and logic ultimately kind of go out the window when we talk about debt, managing borrowed money, and trying to reduce the cost of it? The same three variables are at play. But, we're sort of programmed to focus almost exclusively on the interest rate of a mortgage. And again, that's because people really are driving towards payment affordability, and for good reason. But what if a lender like us could just simply change the equation? Ultimately, just change the way a loan works, how money is applied. What if money was applied directly to loan principal to reduce the balance owed, which then reduces or shortens the time that the customer would be in debt? Ultimately, that serves to reduce the total cost obligation, the total amount of interest they have to pay. And what that creates is payment affordability, because the payment on this loan, the all-in-one, is reducing ongoingly. That's because it's designed exclusively to help people accelerate their pay down, their payoff, lowers monthly and lifetime interest payments, provides 24/7 access to home equity money. So it makes that process very comfortable and very safe and very appealing. It accomplishes these things without refinancing once in place, without a change in budget. Not many people can actually cut back their expenses today. Disposable income is being eroded away by inflationary pressures. Not many people can just snap their fingers and start making more money suddenly as well. So budgetary change really disrupt the household lifestyle. It's hard to do. So what if you didn't have to do that in order to save? And more importantly, what if you could save enormous amounts of money over time and accelerate the pay down of your loan and have access to home equity money without having to rely on favorable interest rates? What if you could accomplish all of this, whether rates were low or high? And that's the all-in-one loan. Here's how it works. It starts with the concept. The concept of the all-in-one loan is the combination of mortgage financing, in which we know most people need in order to possess real estate, and personal banking. Now, when I say personal banking, I'm referring to an actual checking account, a checking account that comes secure with ATM debit Visa cards, check writing, online banking, mobile banking, bill pay, external account linking, ACH transferring, wiring money anywhere internationally, and client services, and much, much more. Now, the funny thing about checking accounts is that we know everybody has one. 100% of mortgage borrowers has one and uses one regularly. So it's really sort of a commodity item or commodity product that people already know how to use. But what most people don't realize is that they probably flow more money through their standard checking account in just the course of 5 years than they actually owe on their mortgage or on a mortgage they're thinking about getting. Let me repeat that. Most Americans will deposit and manage more money in just 5 years through their checking account than they owe on their home. And we know that money isn't spent out that very next day that you receive it. Money actually floats. It can sit idle for days, weeks, and even months before it's needed for bills and expenses. We know this because the Census Bureau tracks consumer spending habits, and we have leveraged that understanding in our creation and development and implementation of this product. It makes sense. We don't go grocery shopping just once a month. We do that weekly. Our cell phone bills aren't due once a week. That's a one-time event per month. So think about how much money tends to sit idle waiting to be spent. And the problem with that scenario is that money sitting around waiting to be spent from a regular checking account earns close to 0% because standard cash accounts earn very little interest in comparison to what we have to pay out on our debts, including a mortgage. I always love hearing people brag about their low interest rate mortgage, but their low interest rate mortgage costs them more interest. It's a higher interest rate and a higher volume of interest paid out than any of their money will earn. Now, I'm talking about the cash they need to keep on hand. So while we flow a lot of money through our checking account, it does very little for us in return. You could really summarize everything up and say that standard checking accounts provide very little value relative to the sort of loyalty that spans decades by customers. And of course, the traditional borrowing and banking process means that there's this sort of invisible wall or barrier between both accounts, between our liabilities, our debts, and our cash. There's this barrier, and our money doesn't get to engage our debts very easily. So we send over a payment, and that payment is amortized, and very little of that goes towards paying down principal in order to reduce our cost and the time in debt. Most of that, of course, goes towards interest. Well, with the all-in-one loan, we break down that barrier and we connect the two accounts together. It just makes practical sense. That connection is accomplished through a technology called sweep banking. And what that means is that when a customer deposits money into the all-in-one loan checking account, their money doesn't sit there idle, waiting to be spent on things over time, earning close to 0%, but instead, it is sent directly over to the mortgage. Deposits are used automatically to lower loan principal, daily loan principal, and save borrowers more interest on their loan than they could have earned by pushing those dollars to a traditional checking account. The savings begins automatically and immediately. So that's achieved by way of how interest is computed and charged on the all-in-one loan. It's not amortized. It's not predetermined. In fact, it puts the customer in much greater control. Interest is computed nightly on the unpaid principal balance. So again, the customer gets to fully control their principal balance of their mortgage. They can have it high, they can have it low. They can push any amount of money into it to reduce it, therefore offsetting or lowering their interest cost. Interest is computed nightly. Simply nightly balance times the rate divided by 365 days gives the account the daily interest expense. Now, customers aren't charged daily. The loan product just recomputes interest daily behind the scenes. Here's an example. If on day one, the balance of an all-in-one loan was $640,000 at 6%, the interest expense for that day would be $105.20. Now, what if that customer made a deposit that next day, driving their balance down to $630,000? Well, that means they reduced that next day's interest expense by at least a couple dollars, down to $103.56. This is what occurs ongoingly. As money is deposited and money withdrawn for expenses, that the interest computation occurs daily. And at the end of the month, each day's interest from the month is totaled up. That becomes the interest payment. That interest payment isn't due until the 21st of the following month, where in the standard all-in-one loan, the non-Texas Homestead all-in-one loan, that interest payment is drafted from the mortgage product automatically. For Texas Homestead property all-in-one loan customers, they have to remit that payment. They have to initiate that payment themselves directly to our loan servicer. This process occurs every single day, every month. Ultimately, what I've just described to you is that the all-in-one loan is engineered to separate the principal repayment process from the interest payment process. We are very used to sending a monthly payment away every single month. For most of our debts, they work the same. It's principal and interest bundled together. And that process really ultimately makes the interest cost sort of invisible to the everyday customer. They're aware that they're paying interest, but they just don't know exactly how much they're paying. Well, the all-in-one loan makes everything visible and gives them greater control. Because of this engineered structure, the interest payment event is separate from the principal. Now, lowering interest payments means faster payoff and equity gain in the property. That's also money that remains securely available for use through all the banking features. Now, this is made possible because this isn't your grandparents' mortgage. This is the all-in-one loan, which actually is a first lien position home equity line of credit. This is what gives it all the flexibility and control factor. It is the most flexible home equity loan in America, and it's structured very differently than standard HELOCs. One of those differences is that the credit limit established remains unchanged for the first 10 years, meaning borrowers can actually write a check up to that credit limit. But after that 10 years, the credit line limit will begin to reduce automatically, evenly, each and every single month to help drive down the credit limit to zero by the 30th year. As an example, if the original line of credit amount was $640,000, you could see how here on screen the credit limit begins to reduce after the 10th year, but it also provides the customer a significant amount of liquidity all the way through payoff. Now, anything in between the daily loan principal and that credit limit remains available for the customer's use 24/7, all the way through. Now, think of all the reasons and all the ways a customer can use this loan. The all-in-one loan is intended for people who need more. Their life is busy. They would love access to credit and liquidity. They want more control of their finances. They want an easier way to save money. This just provides them that. It's a lifestyle product. It's more than just the financing they need to purchase and own real estate. It's a lifestyle loan. Let's take a deeper dive here. Now, I'm going to use really the same numbers to showcase an example. Let's say that we are financing a primary residence. Again, we need to finance $640,000. I'm going to compare this to a traditional loan, a 30-year fixed at 6%. Now, one thing I've often said is it's sort of weird how a customer can get pre-qualified for a home loan without a property picked out, but they cannot pre-qualify for a home loan without having income. Income is everything. The customer's ability to earn and repay debt is ultimately what lending is based on. But what's odd is that those dollars, the entirety of their financial picture, is not utilized after the loan is closed. Ultimately, mortgages are designed just to use a small portion of their income, whereas the all-in-one loan is engineered for the borrower to use all of their income if they want. It's a more powerful source. It's a greater source and sum of money. So as this example outlines on screen, I'm going to compare the standard traditional loan to an all-in-one loan. In this case, a 3-year fixed version, and then it's going to adjust. The current index this month is 3.980. That's the 1-year CMT index. I'm going to use the standard 3.5% margin. That's the most common margin selected and locked in by customers. I'm also going to push the interest rate up as an example on this in this sample here. I'm going to push the interest rate up to 7.941%. We're not there now. Could we go there? Sure. But I want to showcase how a higher interest rate loan can save people money. Let me give you another extreme example before I move forward on the slide. If a customer was interested in saving time and money and then he needed to borrow $640,000, what loan would be less expensive and save them time? Of course, this is rhetorical. I know the answer, but would you save money by getting a 2.5% loan engineered to pay off in 30 years, or a 10% loan engineered to help somebody pay off in 5 years? That 10% mortgage option is less expensive. It saves the customer time. It also creates opportunity. After the mortgage is paid off, what could you do with all that money you would have normally spent on a mortgage? You could probably go build millions of dollars in wealth, so to better fortify your future needs. Now, when a customer gets an all-in-one loan, the process is unique. Prior to closing, we make a QA call. This QA call to the customer is performed by our interim servicing team, led by Lisa Price. And it is its intent is to help set customer expectations and basically QC the setup, the basic structure of what they expect on the loan and what we're about to deliver to them. It also provides the customer an opportunity to ask some frequent questions that we see or hear so commonly. When we do close the loan, shortly thereafter, within about 48 to 72 hours, they will receive an electronic email or letter, I should say, that's a congratulations and what to expect packet. It's a 4-page document. Every loan officer is CC'd on that email as well, and it looks like it's coming from our document server. Again, this provides informational content for the customer so they understand who's going to be servicing their loan and what the timing of their account setup and activation and access will be. And within about 4 weeks, typically, give or take a week in there, the account is fully activated. The customer will receive their welcome kit from our service provider. That would also include their ATM Visa cards, routing number, account number, all their online and mobile application credentials so they could begin setting up their account and using it and saving. So let's just walk through a couple months here. The very first month you get this loan, we start at $640,000 loan balance. We make a deposit. What actually happens is cash is technically converted to home equity dollars. Deposits transfer or sweep directly to the all-in-one loan line of credit, and all those dollars are applied directly to loan principal, paying the balance down that day. Now, interest is recomputing. And of course, money continues to save even while we spend. Borrowers can spend regularly, just like they normally do. Interest is recomputing nightly. What occurs here is that the customer will end the month at a lower balance than where they began, naturally, without any budgetary change. This is because you no longer make a P&I payment out of an all-in-one loan. What the all-in-one loan product does is it converts that money that would normally be expensed towards a mortgage in the form of a P&I payment. It converts those dollars into 100% principal, and that gets deposited into the mortgage. That's part of the reason why it begins to accelerate pay down. Additionally, any residual funds left over. Most people that can qualify for a home loan don't overdraft on their checking account. They tend to have money residually left in their checking account or savings account. On any given day, there's money floating. So that money that wasn't needed this month for bills and expenses also remains in the line of credit as equity money that's available. And that keeps their principal balance lower for longer. Month number 2 begins, another deposit, more spending, and there's the interest payment for month number 1. Doesn't occur until the 21st of month number 2. The third month, presuming the same activity, there's the interest payment for month 2, not charged until month 3. After 4 months, the principal balance is reducing dramatically. What is achieved in 4 months with the all-in-one loan, given the inputs in this example, couldn't be accomplished by a 30-year mortgage until the 12th month. And that 30-year loan doesn't keep the customer's money liquid for use. The long-term results are pretty dramatic. It's mind-blowing for most people to realize how much they could save, how powerful their income actually is. It's the one thing I love about this product, is that people come into this awakening that they actually have all the tools it takes to do better, to save more, to reduce the time and debt, reduce the burden, reduce the headache. They have everything they need except for the mortgage. All we have to do is put that in place. In this example, the customer could be paid off in 15.8 years. That's only 189 months. And they could save over $272,000 in interest costs compared to that 6% 30-year fixed mortgage. It's a dramatic shift in their financial health. So how do we measure potential benefit? Well, we do that through a tool that is hosted on our program website that we call the Interactive Comparison Simulator. And it's very easy to use, just a 5-step process before you get to see the results. The Get Started screen allows a user to set how they want to use the simulator. They could recall a saved simulation or begin a new one. We collect information about the conventional mortgage that they either have in place or they are considering getting. We also collect information about their cash flow behavior, deposit activity, as well as spending behavior and activity. And this drives the customer to the results page very rapidly. Within the results page, there are quite a few features. Right away, we encourage people to hit the Save and Share button. And when you click that, it generates a key code that could be shared with you, the loan officer, could be shared with their financial advisor, their real estate agent. They could keep it on hand to call back and look at, and it pulls up the scenario or the simulation whenever they want so they can make edits. It also allows the customer to create a profile and actually name each simulation they do. There's a rates and assumptions screen where you can change the rate terms. We make all of our margin options publicly visible, so it's very user-friendly. You can also change the assumptions. What if rates drive up? What if rates go down to their historic average? What if they do this? What if they do that? It allows people to really stress test the suitability and the potential benefit using the all-in-one loan, given its rate structure compared to traditional financing. It's an informational tool that also provides a lot of education. This is something that I think lacks. We all know that financial literacy lacks in the United States. People aren't taught. Gosh, you're not even taught how to write checks, really, when you're in school, let alone manage a mortgage and really how to logically think about managing debt and reducing the cost of it. This is used to showcase what could be possible just by using cash or income already received through an instrument people are already proficient at using to reduce the cost on a debt they've got to commit themselves to. It adds information about interest rates, interest rate comparison, and historical values to understand a lot of the assumptions built in and how they can use this to test benefit. It also side-by-sides in a comparison fashion where the loan balance would be and the principal reduced along the way. Also gives a snapshot of the line of credit structure compared to a traditional mortgage and how the balance is being paid down. Also gives a comprehensive breakdown of some of the information that is very valuable, including the break-even average rate and also the comparison loan effective APR. In this example, you could see that the interest rate on the all-in-one loan would need to average 9.747% to equal the same cost as the 30-year fixed at 6%. And of course, we're not there. And for it to average that value, that means that the interest rate would have to jump way higher, probably higher than the maximum rate would be set on this in order to average that value. You can also see that the comparison loan effective APR is 4.063% in this example. And that showcases what the 30-year fix would have to be in order to save the same amount of interest as the all-in-one loan helps. Credit allowances with the all-in-one loan. Here's some basic information. Primary residence is up to $3 million. We do require good credit. We will go up to 90% loan to value. We also offer second home financing up to $3 million. We also offer investment property financing up to $1 million. Now, the rate structure on the product, as I mentioned earlier, is a monthly adjustable. We do have a 3-year fixed and a 5-year fixed option available. The index that we do use is called the 1-year CMT, or constant maturity treasury rate. Currently, it's at 3.98. Its 25-year historical average is right in line with the effective Fed funds rate average, which is right around 2%. It's also comparable to what the monthly LIBOR has averaged over the same time period. Now, there's a lifetime cap set on the loan, and that is based on the initial rate at closing, plus 6%, and that's the lifetime cap. Rates are competitive to interest rates on traditional loans at market level. The most popular product selected is the monthly adjustable, and that's because most people who gravitate and take out the all-in-one loan are also people that come to realize that they would like the benefit of their rate reducing during reducing rate cycles. Now, the guidelines that are much more complete than what's on screen here. Just a couple things to highlight. In terms of structure, there is no impound account. We do not collect taxes and insurance in advance. Customers pay those on their own. As a guideline enhancement, we have a very liberal asset depletion feature that is worth exploring, and it really helps the self-employed, people that otherwise would have a harder time qualifying for a traditional mortgage, given their tax status or how they document income. This helps those people utilize assets without pledging those assets very aggressively with a 120-month methodology. There's also delayed financing that's also available, and that really helps a lot of cash buyers get cash back out of their home pretty quickly without a 6-month seasoning requirement. And I know that there's a community of investors, real estate investors, that love this feature, especially those BRRRR folks, the BRRRR community investors, the borrow, renovate, refinance, repeat folks. The all-in-one loan is a phenomenal product for them. We also allow up to 20 finance properties when our subject is either an investment property or second home. And of course, the customer can have unlimited finance properties if we are supplying the all-in-one loan on a primary residence. Now, that's it. This was a high-level webinar or presentation to help people understand the value of the product. It is dynamic. It's most certainly likely the most revolutionary mortgage product ever developed in the United States. That's my opinion. And, it's worth learning more about. It's certainly worth letting other people realize that it's available. One of our old taglines was one account, infinite possibilities, and that's certainly true. I also like to tell people that this isn't just a mortgage. It really tends to be a solution to the mortgage itself. So it's worth exploring, and I appreciate you listening. As always, let us know if you have any questions.